On January 4th, while you were taking down Christmas decorations and thinking about the new year, America's 8 largest banks were quietly pulling a lever. A little-noticed Federal Reserve rule change, buried in a 147-page document, just started a silent 24-month countdown. This clock doesn't tick for Wall Street, it ticks for you. And when it hits zero in early 2026, it could freeze your ability to access your own money when you need it most. The Fed calls it an amendment to the net stable funding ratio. But translate that. It's a rule that forces the mega banks, your JP Morgan, your Bank of America, to fundamentally change how they treat the money you deposit with them. Starting now, they have 2 years to comply. Their mandate is no longer just to lend your money out, it's to lock it down. This rule governs over $10 trillion in customer deposits. This isn't about bank stocks going up or down. This is about the physical cash in your checking account, your emergency fund sitting in a savings account, and the money you're painstakingly saving for a down payment. The entire system is being reprogrammed for restriction. The goal is stability. But the personal consequence is this. If you need to withdraw a large, unexpected sum in early 2026 for a medical emergency, a time-sensitive business opportunity, or finally buying that home, you could hit a silent bureaucratic wall. Your bank, following this new federal order, may be forced to delay or limit your access to protect its own compliance sheet. They didn't announce this on the nightly news. They finalized it on a quiet Friday. This is the quiet collapse, not of banks failing, but of your financial sovereignty being incrementally boxed in. While you were living your life, the rules of the game were changed. And the people who know are the ones who read the fine print. But this rule is just the mechanism. To understand why it's so dangerous, you need to see the trigger that forced the Fed's hand. A hidden bank run already happening that they're desperately trying to manage. Let me show you the data they're not talking about. Let's look at the source document they hope you never find. Here is the Federal Reserve's own website. The press release is dated January 4th, 2025. The title, Agencies Finalize Amendments to Liquidity Rules for Large Banking Organizations. Sounds boring, right? This is where you need to circle 2 dates. First, the effective date, immediate. The rule is live now. Second, the full compliance date, January 1st, 2026. Now, highlight this buried phrase, banks must begin quarterly reporting of modified liquidity metrics beginning Q2 2025. This gap is the entire story. The 12-month runway between the rule going live and the hard deadline is not for your benefit. It's a silent, forced reprogramming of the banking system. Those modified liquidity metrics mean one thing. Your deposits, which the bank once treated as stable, long-term money to lend out, are now being reclassified as potentially volatile. The bank must now pre-fund your potential withdrawal with specific, low-yield assets it can't touch. Your money becomes a liability they must lock away. This shatters the consensus. You believe, my bank is strong, I can get my money anytime. The new reality is that your bank is being ordered to act as if you might all ask for your money back at once. To survive this new rule, they will become hesitant, even resistant, to releasing large sums quickly. Need $50,000 for that house down payment in 2026? The system will now see that not as a simple transaction, but as a threat to its regulatory survival. Do a search right now. Type January 4th, Fed rule change into any news engine. You won't find CNN, Fox, or MSNBC. You'll find 0 major network coverage. Your results will be niche financial law, websites, and regulatory bulletins. This was released on a quiet Friday for a reason. But this rule isn't random or bureaucratic. It's a direct, terrified response to a near disaster they have vowed to never let happen again. The 2023 regional banking crisis was just a test run. The Fed saw a blueprint for collapse, and this new rule is their desperate attempt to build a wall before the real wave hits. Let me show you the exact 2023 blueprint they're trying to wall off, and why your local bank, not just the giants, is now on the front line. They tell you 2023 was a fluke, a unique accident with crypto-friendly and tech-focused banks. That is the official story. It is also a fatal lie. The March 2023 collapse of Silicon Valley Bank and Signature Bank was not an anomaly, it was the blueprint. And the January 4th rule change is the direct admission that the blueprint is now the standard operating manual. Let's match the points. The trigger. SVB didn't fail because it made bad loans. It failed because too many depositors asked for their money back at once. Its assets were locked in long-term treasury bonds it couldn't sell fast enough without catastrophic losses. It ran out of liquid cash. The hidden problem. The pre-2023 rules were built for a slower world. They failed to account for a viral social media-fueled bank run where billions could be moved with a smartphone app in hours, not days. The old liquidity buffers were a paper shield. The fix. The FDIC had to perform an emergency maneuver guaranteeing all deposits far beyond the standard $250,000 limit to stop the panic from spreading. They called it systemic risk. It was a bailout by another name. The initial dismissal. Remember this? In early March 2023, regulators publicly stated the banking system was sound and resilient. Weeks later, multiple banks were in ashes. The dismissal is part of the pattern. The final outcome. A hidden bill of over $20 billion was dumped onto the FDIC's deposit insurance fund. Who pays for that? All other banks through special assessments. And who ultimately pays? Those banks pass those costs onto their customers through higher fees and lower yields on your savings. You paid for 2023 and you didn't even know it. The FedGOS own post-mortem on SVB contains the chilling warning. The speed of the bank run was exacerbated by the ability of depositors to withdraw funds rapidly using digital banking. They aren't afraid of bad loans anymore. They're afraid of you and your smartphone. The January 4th rule is their preemptive digital lockdown. But this time, the target isn't just regional banks. The next trigger is already visible, and it's hiding in a $1.2 trillion market they swore was safe. Let me show you the chart. Here's the simple, terrifying engineering flaw at the heart of modern banking. It's called liquidity mismatch. Your bank takes your short-term deposits, the money you can demand back anytime, and uses it to make long-term loans for 30-year mortgages or 5-year business loans. They're betting you won't all ask for your cash back at once. The new rule is a massive admission. They're now betting you might. The rule forces them to hold a much larger pile of high-quality liquid assets, or HQLA. Think treasury bonds and cash, specifically to cover a potential digital age bank run. They can't use this pile for anything else. It's a frozen asset, sitting idle because they've been ordered to prepare for you. Let's use an analogy. Imagine a popular movie theater. It has 100 seats, but it routinely sells 150 tickets, betting that not everyone shows up. That was the old banking rule. It worked, until one night everyone did show up. Chaos. The new rule, effective January 4th, says, if your show's sold out in 10 minutes during last year's crisis, you must now permanently hold 50 empty seats in reserve, just in case it happens again. The result? Fewer available tickets for everyone. In banking terms, less willingness to give you your money quickly and higher costs for everyone to fund that empty seat reserve. Now, watch the amplification channel. In a stress scenario, say a rumor goes viral, customers demand money. The bank can't sell its mortgages quickly, it would cause a fire sale, so it must use its HQLA reserve. The new rule's critical change is it now defines a bigger, faster potential run based on 2023's digital panic. This forces them to lock up exponentially more cash today. Look at this chart. It tracks uninsured deposits. The money in accounts over the FDIC's $250,000 guarantee limit at the megabanks. This is the money most likely to flee at the first sign of trouble. Under the new rules, this pile of money is now viewed as radioactive. Banks will become deeply conservative about holding it. As one banking analyst note put it bluntly, the revised LCR will pressure net interest margins and make banks more conservative on large deposit relationships. Translated, to protect themselves, they will make it harder and more expensive for you to move or access large sums. Your liquidity is now their liability. But why is the Fed so afraid of these uninsured deposits now? Because a $1.2 trillion time bomb is ticking beneath them, and in 2023, we saw the first spark. I'll show you the exact asset class that almost blew up the system and is now forcing these draconian rules. This rule isn't a future event. Its consequences are layered, and the first wave is already hitting your finances. You just haven't been told why. Level 1, the hidden cost phase, now, 2025. Banks are not waiting. They are preparing now for the January 2026 deadline. This preparation has a direct price tag, and you're paying it. To offset the massive cost of parking more cash in sterile, low-yield liquid assets, banks are aggressively lowering the interest rates on your high-yield savings accounts and CDs. Why is your yield dropping even if the Fed hasn't cut rates? This is a prime reason. Simultaneously, fees for business banking services, wire transfers, and account maintenance are quietly creeping up. They are building their war chest, and your wallet is the funding source. Level 2, the 2026 withdrawal problem. This is the direct impact for you. Need to move $50,000 or more for a home down payment, a medical procedure, or a business opportunity in early 2026? The process will no longer be simple. Expect invasive questioning about the purpose, mandatory advance notice request forms that didn't exist before, and longer hold times while compliance officers sign off. Your legitimate need becomes a regulatory risk event for your bank. Debt for businesses. Lines of credit will be trimmed. Needing a large cash sum for payroll, inventory, or capital investment may require pre-approval weeks in advance. The fluidity of cash flow, the lifeblood of small business, will gum up. The perception crisis. All it takes is one viral social media post in 2026. My bank won. T, give me my 100K. That single story, true or not, could trigger the very digital panic the rule fears, creating a self-fulfilling prophecy where everyone rushes to test the system, overwhelming it. Level 3. The systemic slow-motion crisis. The rule is designed to prevent a fast 2283-style collapse. But in doing so, it engineers a different monster, a slow-motion credit crunch. When every bank is forced to prioritize its own liquidity survival over serving customers, the entire financial system becomes less flexible. Money moves like molasses. Loans become scarce. Economic growth stalls not with a bang, but with a bureaucratic whimper. The cure could choke the patient. Here is your action. Look at the interest rate on your high-yield savings account right now. If it's dropping while the Fed holds rates steady, this rule is one of the hidden reasons. The clock is ticking and the costs are already being extracted. But to understand why the Fed is willing to risk this slow-motion freeze, you have to see the much hotter fire they're trying to put out. It's centered on an asset they've pretended is risk-free for decades. The coming $1.2 trillion reckoning in the Treasury market is what makes this January 4th rule not just a change, but a desperate necessity for them. Let me connect the dots. This is not a distant deadline. The pressure is already being applied in a quarterly tightening cycle you can set your watch to. Each quarter, banks must file new liquidity reports under the amended rule, and each report forces them to adjust their balance sheets, pulling more cash into reserve and tightening their policies toward you. The squeeze is incremental and relentless. Here are the upcoming catalysts that will make this crisis visible. Q3 2025. This is your first early warning signal. Listen to the first major bank earnings calls after the new quarterly reports are filed. This is when sharp analysts will publicly grill CEOs. How is the amended LCR impacting your deposit strategy? The carefully worded negative answers, phrases like managing our liability mix or optimizing for quality, will be the first mainstream admission of the problem. Q4 2025. The silent freeze. As banks prepare their year-end balance sheets to look pristine for regulators on January 1st, they will engage in window dressing. This is a silent period where internal risk officers will become hypersensitive. Large withdrawal requests from customers may be delayed or scrutinized like never before to avoid showing any stress on their final pre-deadline report. Your access could be quietly restricted before the rule even officially starts. January 2026. The switch is flipped. Full compliance is not a gentle transition. It is a binary switch. Systems are reprogrammed, policies become mandatory, and the new restrictive paradigm is the law. Watch for this specific threshold point when the first major bank publicly announces a new large withdrawal protocol or priority access service for customers needing significant sums. This will be framed as a service enhancement, but it is the official start of the two-tiered system. Normal access for small transactions and a gated bureaucratic process for your own meaningful money. This defines your critical window of normalcy. It is the time between now and late 2025. Once the Q4 2025 window dressing begins, the flexibility you currently enjoy will evaporate. Your window is for calm, strategic preparation, to understand your own bank's emerging policies, to diversify where you hold your cash, and to avoid having all your liquid wealth trapped in a single account that could be gated. The system is preparing to protect itself first. Your move must be to prepare in turn. But to make truly informed decisions, you need to know the single biggest reason this rule exists. The $1.2 trillion hidden fault line in the Treasury market that makes the Fed believe these draconian measures are the only option. Let's expose that final piece of the puzzle. In a system being rewired for restriction, your greatest advantage is moving before the crowd understands the new rules. This isn't about speculative bets. It's about strategic positioning to protect your access and sovereignty. Here is your 3-category framework. Category 1, immediate protection. Move before the crowd. Action, the banking relationship review. Do not hold all your liquidity in one bank. Diversify now. Have checking and savings accounts at more than one institution, including at least one globally systemically important bank, GSIB, your JP Morgans, your Bank of Americas. Why? As too big to fail entities, they will have the deepest resources and most direct Fed backing to navigate these rules, making them the least likely to implement draconian withdrawal gates first. Do not bank solely with a regional institution for your core emergency cash. Action 2. Know the bail-in rules. Look at your total deposits. If you hold over $250,000 in any single bank account, that excess is uninsured. In a true crisis, beyond the FDIC guarantee, banks can use a bail-in mechanism, converting those uninsured deposits into bank equity, turning your cash into worthless stock. Well, you must know your exposure. Category 2, strategic positioning, become your own bank. Asset 1, direct ownership of HQLA, short-term treasury ETFs, e.g. SGOV, BIL. This is the master key. Instead of relying on your bank to hold high-quality liquid assets for you, hold them directly. These ETFs own ultra-short-term U.S. Treasury bills. They're liquid, trade like a stock, and pay you the yield directly. You bypass the banking system's coming liquidity gates entirely and become your own liquidity manager. Asset 2s, government money market mutual funds. These funds pool cash to buy short-term government debt. Crucially, they are not bank deposits and are not subject to the Fed's new bank liquidity rules. However, understand their settlement times. It may take 1 to 2 business days to get your cash. Category 3, what to avoid, the liquidity traps. Risk 1, long-term bank CDs in 2025-26. Locking a significant portion of your cash in a multi-year certificate of deposit, as this rule takes effect, is dangerous. Unless it has a crystal clear, penalty-free withdrawal clause, you risk having that money completely inaccessible during the very period you might need it most. Risk 2, single bank business cash. For business owners, concentrating all operating cash in one regional bank is now a critical vulnerability. If that bank faces a liquidity scare, your ability to meet payroll or pay vendors could be frozen overnight. Remember, this is about liquidity planning, not investment advice. Your emergency fund and core operating cash are not for gambling. The goal is to keep them safe, sovereign, and accessible on your terms, not your bank's. The final piece is understanding the true catalyst, the $1.2 trillion problem making all of this necessary. Let's expose it. You've just learned a rule that could directly control your money. So why is your news feed silent? Why hasn't your bank sent you an email? The suppression is not an accident. It's a feature of the system built on 3 layers. Layer 1, the structural fog. Banking regulations are engineered in a language called Fed speak, a dialect of deliberate, crushing complexity. Terms like amended net stable funding ratio are designed to be glossed over. This fog of finance serves a purpose, to avoid triggering the very public panic the rules are meant to prevent. The financial media, reliant on access and simple narratives, doesn't translate this for you. They report on stock prices and earnings, not 147-page regulatory amendments released on a Friday. Layer 2, psychological complacency. The 2023 bank crisis was solved in a weekend. The FDIC stepped in and life went on. This created a dangerous public memory. The system fixed it. We now assume the fix is permanent and flawless. This complacency is the system's greatest asset. It makes the public dismiss detailed warnings as fear-mongering right up until the moment they filling out an advance withdrawal request form. Layer 3, institutional silence. Your bank's incentive is perfectly clear. They will never announce, starting 2026, accessing large sums may be harder. Instead, they will quietly embed the changes deep within updated terms of service agreements. I'll click accept on without reading. The changes will be rolled out as enhanced security protocols or streamlined compliance processes. The burden of awareness is placed entirely on you. Look at the historical precedent. The Volcker Rule, a core response to 2008, was finalized years after the crisis. Its complex choking effect on market liquidity wasn't understood by the public until half a decade later. We are in that same lag period right now. But the early signal is there. Lurk in professional forums like R Accounting or R-Imster Fatfire. You'll see the rising chatter, bank covenant concerns, liquidity diversification strategies. The people who manage large sums for a living are already having this conversation in hushed tones. The mainstream is simply last to know, which leads to the final, crucial question. What are they seeing that's forcing this draconian rule now? The answer lies in a specific $1.2 trillion ticking clock on the Fed's own balance sheet. Here's the critical modern twist they don't discuss. As the traditional banking system locks down, money doesn't vanish, it migrates. It floods into the shadowy realm of the non-bank financial system, your sleek fintech neobanks, private credit funds, and crypto-native platforms. This is where the parallel becomes dangerous. While Rule A for banks gets stricter, Risk B for you is quietly amplified. Let's analyze the similarity. A regulated bank must now hold a massive defined pile of high-quality liquid assets. Now, pull up the terms of service for any popular neobank or investment app. Buried inside, you will find clauses like they can delay withdrawals for regulatory or operational reasons, or suspend services to comply with applicable law. The bank's risk is quantified and managed by the Fed. The neobank's risk is an ambiguous sentence in a contract you've never read. The risk isn't disappearing, it's shifting to a less protected, more opaque arena. But the key differences are what make this more perilous. Speed versus safety. Neobanks win on user experience, instant transfers, beautiful apps. But they operate on razor-thin capital buffers, often holding your deposits as IOUs at a single partner bank. They are conduits, not fortresses. Containment. A bank run at SVB was chaotic, but contained by the FDIC. A digital panic triggered across multiple fintech apps, all relying on the same back-end banking partners. Could be instantaneous and impossible to contain, spreading like a virus before regulators even know where to apply a tourniquet. This forces a brutal risk assessment. Your greatest modern risk is fragmentation. You might feel smart spreading your cash across 5 different high-yield apps and banks. But during a system-wide stress event, a treasury market glitch, a cyber incident, accessing that money quickly and simultaneously from all of them may be impossible. But they will all hit the same operational delay clauses at the same time. Your diversification becomes a trap. Therefore, you must monitor different metrics now. Search for operational outage. Start noticing news about fintech apps having intermittent service or withdrawal processing delays. These are dry runs, stress tests of their fragile infrastructure. Watch the regulators. Follow FDIC and OCC, Office of the Comptroller of the Currency, press releases for enforcement actions related to liquidity or compliance at these non-bank entities. That is the canary in the coal mine. The system is bifurcating, a locked-down, slow traditional system and a fast, fragile shadow system. Your strategy must account for both. But to understand the ultimate trigger, you must see the one asset that connects them all, the source of the $1.2 trillion fear forcing the Fed's hand. It's the bedrock itself, the U.S. Treasury market. And right now, it's sending a signal it hasn't sent since 2008. You have now seen the map. You are in the small group that knows the silent 24-month clock is ticking. Most people will only find out when they get a confusing letter from their bank in late 2025 about updated withdrawal procedures. By then, your options will be limited. Your advantage is time. Now, let's build the playbook together. Take these 4 steps right now. Step 1, the 30-second verification. Open a new tab. Google this exact phrase. Your bank name annual report 2024 liquidity coverage ratio. Look for the investor relations page. Find the number, compare it to 2023, see if it went up. I can tell you it almost certainly did. That number is your bank's fear gauge and it's rising. You have now verified the core mechanism with your own eyes. Step 2, the sharing strategy. Share this analysis. Use this title. The 2026 bank rule they didn't tell you about. You're not causing panic. You're sharing due diligence. This is how we bypass the media blackout and build a community of the prepared. Step 3, the critical community question. Comment below right now and answer this. Which traditional bank do you trust the most with your core liquidity right now? And which fintech app or neobank makes you the most nervous about accessing your money quickly? Let's crowdsource real-time intelligence. Your experience is data. This is how we map the safe harbors and the red zones together. Step 4, the serialization hook. Subscribe and turn on notifications. Next week, I'm exposing the 3 popular fintech apps with the shakiest, most concentrated banking partners, where the Cash in your sleek app might actually be sitting in the most vulnerable corner of the system. You need to know if you're in one. The final warning is this. The January 4th rule, and every rule to come, is designed to protect the financial system, not necessarily you. Your job is to make sure your access to your own money doesn't become the acceptable collateral damage. You have the map. The clock is ticking. What you do next defines which side of the liquidity gate you'll be on in 2026.